Hi, we are students from St. Joseph's University, and today we will be going over our CQA Investment Challenge results. We will first describe our investment philosophy, then the sectors and risks associated with our portfolio, and conclude with our performance and expectations. As an introduction, my name is Emily O, and I am an MBA student concentrating in finance. Our investment philosophy focused on valuation, quality, momentum, and growth. We focused on long and short-term stocks that would help us maintain a net portfolio beta close to zero. Our portfolio consisted of energy stocks that had high betas and momentum, which would yield greater returns for our portfolio. We complemented our energy stocks by selecting stocks in the industrial and financial sector in order to balance our portfolio.
My name's Don DeWeese, and I'm a graduate student at the Halb School of Business. I'm a deep value, contrarian, Dodd and Graham style value investor. I have a keen interest in special situations and turnarounds, and I recommended a overweight to energy, materials, and natural resources in our portfolio on the long side. I believe that they are poised to do well over the next market cycle, which should be characterized by synchronized global growth, rising interest rates, and rising inflation. My only hope is that the scenario unfolds over the 5 months of this contest and not over the normal 3, 5, 7 years for a market cycle.
We have chosen a variety of stocks from the industrial sectors to include in our portfolio because of expectations of strong performance. One of the reasons for this is global manufacturing has improved. In addition, U.S. manufacturing remains expansionary. Another reason is strong corporate balance sheets allow management teams to invest in new, more efficient equipment to offset weaker productivity. The final reason is most central banks are maintaining accommodative policies and keeping interest rates low, which allow for investment in this area. The risks that involve this sector mainly deal with higher interest rates, and the first one is if the central banks around the world decide to move more towards a fiscal austerity policy, and as a result this would dampen growth in the sector. Finally, if inflation rates should reach concerning levels, another risk would be the Federal Reserve is more aggressive in their interest rates hike, and this would reduce the overall investment and dampen some growth in the industrial sector stocks.
Hi, my name is Nick Schaefer. I am a junior finance major with a chemistry minor at St. Joseph's University. I was the one that conducted research on which financial institution we were going to invest in order to help diversify our portfolio. We wanted to stay in line with our overall strategy of investing in energy stocks, and by doing so we decided to invest in banks and financial institutions that were most heavily involved within the energy sector. This led us to Bank of America and Morgan Stanley. Bank of America was selected because it actually has the largest amount of capital amongst all the major banks invested within the energy sector. Morgan Stanley, on the other hand, does not have as much total capital invested in energy. They aren't even the 4th or 5th most invested bank on the list. What they do have is the highest overall percentage of their total loans that they have issued made out to oil and energy companies. We believe then that these two banks, Bank of America and Morgan Stanley, seek to gain the most of all other banks when a rise in energy stocks were to occur.
Hello, my name is Michael Jenkins, and I'm an undergraduate physics major and finance and math minor at St. Joseph's University. Now let's talk about our portfolio performance so far. Currently we have a portfolio value of $992,200, and we have a return percentage of a negative 0.78%. Our beta is 0.21, and our cash balance is $21,400. Overall, you can see in the graph below that our best performance came between the beginning of December and around the end of January. And during the end of January to the beginning of February, our performance tailed off due to the fact that some of our positions didn't turn out the way we expected them to. Overall, we have been recovering that, and in the future we expect to make up our losses and provide a positive return.